You note 8 steps. So I'll read them out really quickly. There's don't look at the stock price. If someone tries to sell you something, don't buy it. Don't talk to management. Gather investment research in the right order, aka SEC filings first and then opinions last. Discuss your investment ideas only with people that have no axe to grind. Never buy or sell stocks when the market is open. If a stock tumbles after you buy it, imagine that you can't sell it for 2 years, and actually you updated that in your most recent annual report to 5 years. And also don't talk about your current investments. I was interested, sitting here in 2023, are there any other key points you've added since writing the book? Anything you've added to your investment process, or are there any of those points that you wrote that you feel differently about now?
So definitely there are points that I feel differently about. The most important one is number 3, don't talk to management. That is a bad idea. You should talk to management. Yes, absolutely. The idea that you would that I would upfront close off a whole channel of information without evaluating it is just it's amazing that I wrote it in there. I look at it and I go, how on earth? And I did. I wrote it. I believed it at the time. I think that the analogy that I like to use is that I'm not a forester. I've never picked up a chainsaw, but I have heard of the title of a movie called Chainsaw Massacre. And as I understand it, chainsaws are particularly dangerous instruments, especially around limbs. Anyway, you get the picture. So the question is, should you ever pick up a chainsaw? And the answer is, if you need to cut down a forest full of trees, a penknife ain't going to cut it. You're not going to, so what am I going to do? Not have a chainsaw? Yes, a chainsaw is an extremely dangerous instrument if not used correctly, but it's absolutely necessary to cut down a forest. So you need to use it with great care and respect for the dangers that it poses. And so I would say that speaking to management is a bit like a chainsaw. I mean, management know so much and have so much knowledge to give, and are at the center by definition of a very, very powerful network of people who are specific to that particular company and industry. So the idea that you would rule out speaking to them is a very bad idea. I think that what I say to myself now is that it kind of comes under item 4, which is, don't speak to the management up front. Don't let them boondoggle you or bedazzle you. Approach them intelligently, armed with the right background information, insights, and evaluate them intelligently, so that it's a bit like read the instruction manual before you pick up the chainsaw. So that is something that certainly I just disagree with, and it's kind of like to say it up front, because until I do an updated version of my book or write something else for publication in which I will get to correct it properly, I feel like it's out there and it's something I disagree with. I don't feel bad about it. We should welcome changed opinions in ourselves. When we change our opinion, that means we're growing and learning, and that's a good thing. Somebody who doesn't change their opinion on anything is not growing and learning. So it's fine to change one's opinion and to change your process and to change what you do. And so that's one thing very, very clearly. I think that on the others, it's more a kind of a refinement or modification. I mean, speaking about number 8, talking about your investments, I think that, again, that's kind of like too rough a statement. It depends on who you talk to your investments about. And you can go from one extreme to talking on CNBC or to Jim Cramer about the company that you've invested in and why it's going to the moon or not. And then there's talking to one close friend. And then there's all the variations in between. So, I found that talking to my investors, the people who invested in the fund, is a very, very good thing to do. It's a very, very different kind of conversation to pitching my stock on CNBC, and even within that there are kind of variations. So what I try to do, and I don't know if I talked about this in the book, even if you're talking one-on-one to somebody, there are people who are really curious about the world and want to learn more, and there are people who just want to demonstrate that they're right. You want to get more into the category of people who want to learn about the world. You want to get into the category of people who don't want to tell you what to do, but who are curious, who want to share with you what they did or how they went about it. So So exactly, exactly how you talk about your investments is more interesting. Exactly how you talk to management is more interesting. And I'm just gazing down the list here because Brandon sent it to me in a very, very nice document. He did quite a bit of preparatory work here, I should let you know. So refinements, I mean, look, my checklist is now, I think, beyond 80 items. So every year in my letter, the letter's top of my mind right now because I just was reading it and editing it. There's 3 new checklist items that were added to the letter this year. And, again, those are kind of refinements of, and what I do with the checklist is I look to see where other people have made mistakes, and I say, hopefully they're not my mistakes. And I say, oh my God, that's a checklist item. I could add that in, So I'll just give you one. So, what is amazing to me about the period of 2022 is these companies that I yearned to own, Brandon. I was just like, wow, I would just so love to own Roku. I'd so love to own Snowflake. They're so clearly such amazing businesses. And then suddenly I look at them again with a fresh set of eyes after the share prices have dropped so dramatically. And I kind of say, how on earth did the guy you were only 6 months ago want to own these things? So a simple checklist item is, do they need the capital markets to be open in order to continue to run their business? And I think that, so just to go into the nuance of this, Warren Buffett has said that he wants to own, he would not mind if the stock market was closed for 10 years. And so he didn't have a quotation on the value of the businesses that he owns. He doesn't need the stock market to be open to tell him what the business value is. But then there are some businesses that positively need the capital markets to be open. They cannot run their daily operations if the capital markets are not open. And that may be either because they're funding their losses. They're actually a venture capital investment, and they're not even making money on an operating level, and they need to raise money either through equity issuance or through bond issuance, and I don't want to be invested in those businesses. And in a certain way, those are not good investment. Well, they're kind of venture capital investments, but that's now a checklist item. And many of the companies that I wanted to own last year, they were all kind of like unit economics. So, we're losing money, but if you go on a unit, on a customer, if you do the analysis down to the level of a customer, over the lifetime, the customer is a very, very profitable customer for us. And because it's such a profitable customer, we're going to spend enormous amounts of money in these next few years acquiring as many of them as we can. And then we're going to have this brilliant future a decade out where all these companies are going to be customers are going to be so profitable for us. But when you look at the income statement, you see a company that's making an operating loss and is raising money from the capital markets. And so one checklist item is, I just don't want to be around those people. And if you're a really good business, then you can spend money on acquiring new customers and doing R&D and developing your products while not raising money from the capital markets. And there are businesses that do that. I mean, I don't own them, but Facebook does that. Facebook, everybody's upset because they're spending, $10 or $15 billion a year on the metaverse. But they're not spending that by raising money. They're not doing a convertible bond issuance. Netflix, not that long ago, issued $18 billion worth of convertible bonds, I believe, in order to invest in new content. And my question is, if you're such a good business, why can't you do that from internally generated cash flow? Anyway, I'm on a hobby horse here. I should stop.
No, continue.
Over to you.
I find it interesting.
Well, there we go. That was my point. Yeah, that's okay. One of the checklist items that I added, and it's just a simple idea. Do you, in some sense, it's like, do you make an operating profit? At the end of the month, at the end of the year, do you have cash in the bank where you get to decide where to spend it? Or, is your CFO wondering what to do with the excess cash? Or is your CFO wondering where to get the money to fund your operations and your plans, And, it's like, there's this simple idea, and it's funny because it goes down to individuals as well. There's somewhere, this is one of these kind of like wise sayings, how rich or poor you are or feel, and how abundant a life you live has got nothing to do with the absolute levels of income and expenditure. It's just got to do, if you spend if you spend 1% more than you make, you're always going to be miserable and money's always going to be tight. If you spend 1% less than you make, life's going to be great, you're going to be abundant, and you're going to be able to save and all of those things. And that's just a simple decision. Well, it comes down to corporations as well. You can see corporations the same way, and there's a whole class of people out there whose eyes are bigger than who see so much opportunity and don't care where the money comes from. And those are not terrible people. That's the whole of Silicon Valley in a certain way. And Silicon Valley has given us so much. So I'm so happy that those people are out there. But I just don't want to be invested with them. And then there's another kind of person who always says, we're at the end of the year, we've got this money in the bank, or we're projected to make this much money. What are we going to spend our money on? How much are we going to send back to our investors? And they constantly live within their means, if you like. And those are just better, from my perspective, those are better people to be around. And so, in a certain way, just going back to your previous question, so, how do you build your environment in such a way that you are going to be a better investor? And, in my book, we talk about, where to put the Bloomberg monitor or where to live. And I know I've talked a little bit about going to the Berkshire Hathaway meeting, or what kind of friends do you have in your life, or when you talk about stocks to the people that you talk about them to, how do you talk about them? But then you get to kind of like, in a certain way, advanced environment building is, in a certain way, if I own the shares of a company, I've invited the CEO of that company into my life. I'm, whether I like it or not, in a relationship with that CEO and that whole ecosystem. So one of the great things about owning Berkshire Hathaway shares is that you're kind of inviting that whole ecosystem into your life. And Brandon, as you know, because you've been, it's an amazing ecosystem. Why would you not want that in your life? I own shares of an investment firm based in Turin, Italy, which is this company Exor, which is the chairman of Ferrari, is also the chairman of Exor. And I think he's a really astute guy, and it's really annoying, Brandon. He's 10 years younger than me, and he's sort of like Italian royalty. His name's John Elkann. But in part, I'm invested there because I want to be a part of that ecosystem. It's a really, really good ecosystem, and that ecosystem will then impact me. And so who I'm invested in, getting around people who think in that way, who think not the world's full of opportunity and I just need to find people to give me money so I can pursue that opportunity. Rather, people who say, how do I spend less than I make? And then when there's something left over, how do I find intelligent things to do with what's left over?
So we've been talking a lot about, I guess, all these practical steps as to, staying rational and surrounding yourself with the right people and making sure that you're in that world. And I guess this is all very applicable for people that are interested in making individual investments like Warren Buffett style investments. I'm also interested, I just wanted to finish up talking about the concept of passive investing, which is the other end of the spectrum, which I guess you do have to detach yourself from your emotions, but it's a much different strategy, dollar cost averaging, where you just keep plugging away no matter what's happening in the market. I'm interested, obviously your investing is very much about finding stocks that you hope will outperform the market, but I wanted to circle back to the new investor, the investor that's just getting started. As someone that has done this for decades and decades, do you kind of gravitate more towards, maybe if you're a new investor, passive investing is just a good way to go? Or do you think that people should try from the start to educate themselves in business and in investing in that Buffett style and kind of fail and pick yourself back up? And do you think that's a better long-term strategy?
So I think that probably this idea of dollar cost averaging is good across passive investing and active investing. So
right.
In an ideal world, and I did this when I started the fund and I took over a laddered bond portfolio. I told myself, rather than when I saw a good idea, rather than sell down the bonds to buy that good idea, I sort of just allowed those bonds to mature over time and used that cash as it became available. So that was a kind of a dollar cost averaging into individual stocks. And then I think that, deciding the world is full of so many different kinds of people. And I think that it comes down to the individual of knowing yourself and knowing, or at least, and if you don't know yourself, being willing to undertake the exploration of who am I and what kind of relationship do I want to the world of business and investing, I guess. And I think that, all options are valid. All sensible options are valid. Taking your money to a casino or to the equivalent of a casino is not a great way to preserve your wealth. But to say, and the great thing about investing in public securities is that you can decide. You don't have to do one or the other. So I don't think that there's anything wrong with somebody saying, look, I know that the index is going to work pretty well, but I do want to spend some time doing some of it on my own. So I'm going to do 1/3 the index, and I'm going to pick an index, and I'm going to do 1/3 individual stock picks, and I'm going to do 1/3 cash because that's going to make me feel safe. I wrote something a while ago that, interestingly enough, might be something for a follow-on video along the thing that we talked about, in which I asked the question, with whom would I invest? And the question I ask is, if I wasn't doing what I'm doing full time, how would I go about it? And what I came down to was kind of like, I want 5 buckets, if you like, or 5 different things, because more than 5, you get a headache. But one of those things might be an index. Another one of those things might be a company like Berkshire Hathaway or Exor. Another one of those things might be an individual business like Nestle or Moody's or something. And I would just do 5 of them, basically. So you can kind of have, what you've just divided into active and passive investing. You can do 50-50, or you can do 1/3, 1/3, 1/3. And, but I think that the key is to know yourself and know what your interests are. And if your interests are somewhere else, then that's totally fine. Do an index,
And I'm interested as well. I'm conscious of the time as well, so I'll just finish off with this one last question, and then let you go. Obviously, you are an active, fund manager. So I'm very interested to hear your thoughts, because we all know that the majority of active fund managers don't beat the S&P 500 over a long period of time. I think it's in the States, it's like over the last 15 years, 89% of active fund managers haven't beaten the market. Your fund is one of the rare exceptions, which is great.
By a very minor margin.
Yeah,
the margin's very slim.
But I'm wondering, why do you think it is that so many active managers don't succeed in this task? And I guess if investors want to look at a fund manager or someone they trust their money to, what sort of qualities, what should they be looking for in that fund manager?
In the last 5 years, I think, Brandon, I have not beaten the S&P, including last year. A part of my letter is writing about why, even though I got so many things right, I still didn't beat the S&P last year, which is a kind of a frustration for me. But hopefully, I'll be, good things will happen for me this year or the following year. I would also say that the margin by which I've beaten the S&P is slim. It's like about 1%, as net of all fees, but it's a slim margin. It's really, really, really tough to do. And I think that, so I just had a conversation yesterday with somebody, those listeners who kind of into this stuff may really enjoy getting his book. He's a guy called Luca Delana, and he's written a book on a word that all my non-math friends are going to be upset at me for saying. It's called ergodicity. But I just want to explain the idea here, because Brandon, it's a really, really, really powerful and important idea. And I'm going to explain it in the way that Luca Delana explains it, which is, I guess you don't get much skiing in the parts that you are, but...
Unfortunately not.
Yeah, so the skier who wants to win the season has to make a very, very difficult trade-off, because if he skis the fastest possible, he increases the likelihood of injury. And if he injures himself, or she injures herself, then they're not going to get to the end of the season. But in the dynamics of the individual race, there is enormous pressure to ski as fast as you can and take a hidden risk that you will get injured. And when you win the race, nobody says, oh my God, you took all these hidden risks. That actually wasn't optimal for the whole season. And so there are things that appear optimal from one perspective, which are not optimal from another perspective. And often I think that we as investors get the perspective wrong. And so, if I was to go into the task of running a great fund and I try to put up really, really good numbers, but I take hidden risks to do it, and then at the end of 5 years or at the end of N years, I blow up. And that happens constantly and consistently. And so that's a big part of what makes it extraordinarily hard to have a long track record, and especially a long track record that beats the index. I think that what I figured out maybe a decade ago was that because it's so hard to beat the index, and because such a big proportion of the fund is either immediate family, myself, or people that I know well, and I'm not willing to take hidden risks in order to juice returns and then show up 1 year and be down permanently 50% and trash the track record and blow up. What I did was I realized that what I could do is drive down the costs of investing with me. And funnily enough, as a guy who's a, quote, active manager, I've driven myself to be incredibly passive, because what I see and what we all see at Berkshire Hathaway is that you can, if you get the right businesses into your portfolio, you can do extraordinarily well. And that frees up an enormous amount of, when your intent is to be passive, you free up an awful lot of brain cycles to think about something else. And actually, speaking of that, just going back to your list, or my list of 8 things that you read back to me, I think that I actually look at the stock price even less frequently than I used to. So it's just like, it's just not worth looking at. It's not worth looking at it because it just drives brain cycles. You're better off just reading the 10K once a quarter or even every 6 months.